Before you sign on the dotted line, see what's good, what's bad, and what's ugly about life insurance and life insurance strategies. Drawback number one, higher initial cost. The initial cost of some life insurance policies, especially whole life, can feel extremely high compared to other financial avenues. There's a premium to be paid for future peace of mind, and for the rookie investor out there, or for those on a tight budget, the price tag can be daunting. So whenever we get into the higher cost conversation, listen, up front it could cost more, but on the backside, it could cost you a lifetime. Because if you buy term insurance, which is very inexpensive for a certain amount of time, when you get past that term, it becomes very expensive and you could lose a death benefit at a time in your life when you may need it. Why is a death benefit important? Not so when you shuffle off this mortal coil, but to be able to replace and or spend down your assets in life. And it's an important thing to understand. So when it comes to the higher cost of whole life, we structure systems and processes that allow you to overfund early and often, reduce the cost of insurance, and give you more access to your money. Drawback number two, complex products. Life insurance policies are complex. Dive into the intricacies and you'll find terms and clauses that can make your head spin, and it's a contractual commitment. Now, when you look at some of these products and when you look at some of these policies, they could be an L95, pay up till age 95, pay up till age 65, or an L20, whatever the case may be. Whenever you fund these policies, and if you're overfunding, but somewhere along the line, certain things happen financially where you can't afford it, there's a lot of built-in redundancies there. If the cash value is really high, or if the dividends are there, they can help offset your premium. And if you have to borrow from your policy at any given point for a quarter or for a half a year or a year, you have the ability to do that. Yes, it is a commitment, but it has a lot of flexibility if it's done the right way up front. Drawback number three, long-term commitment. These policies are unhelpful if you have to step away after a year or two. If you're financially wobbling, trying to balance high interest debts or living paycheck to paycheck, then you may want to hold off. This is critical. Obviously, you want to do a full cash flow analysis up front. You want to make sure that you really understand what your savings goals are on a monthly basis. How much do you have in savings? What does your budget look like? If all that's in order, an economic winter comes your way, and for 6 months or a year, there's some changes you have to make, you'll be in good shape because you're prepared properly. Benefit number one, tax advantages. As your policy's cash value grows, you're not paying tax on that growth year by year. By borrowing against your policy, you can get access to your own money tax-free. There is also an income tax-free death benefit. So here it is. As you fund the whole life policy or an IUL, anything you put up in there, let's say you put $1 million in there over 20 years or over 10 years, and then over 30 years it's worth $2 million. Well, the first $1 million is tax-free up to basis, and then after you cross basis, that's where the taxes come in. But if you're borrowing the whole way through, you'll always put yourself in a position where you don't owe taxes. If you want to learn more, don't forget to click the link below. You'll be able to access one of the members here at Epic. It'll take you through the success process and answer any of these questions. But that's an important question to get into. Benefit number two, loan options. You could borrow against your policy. You control the repayment, and the policy can still earn dividends uninterrupted. That's a beautiful feature. Always aim for your policy to earn more than what you're being charged in interest. You want the arbitrage to be in your favor. That way, you can put yourself in a position when you borrow. Remember, even if the arbitrage is in your favor, you want to buy an asset that's producing its own income. You want to you want to purchase an asset that's going to allow your net worth to grow. Be careful to borrow from a policy to go buy an alternative investment that may not do anything for the first 5 or 10 years because you have to pay interest along the way. Benefit number three, estate planning. Proper estate planning ensures your wealth trickles down to the next generation. For couples, it's the death of the second spouse where the estate taxes hit hard. Properly structured trust can help those death benefits outside the estate's reach, ensuring your legacy remains untarnished. Now, listen, think of the waterfall method. Think of the, what the Rockefellers did. Basically, they set up, I'm going to keep it simple, but it's much more complicated. They set up a trust. In the trust, the trustee is the person that set up the trust, not necessarily the Rockefellers, but they had language and governing rules within that trust on what can and cannot happen. Each descendant or family member, there was a policy put on them. So all this cash value and all these policies, whenever somebody wanted to buy a house or borrow from the Rockefeller Bank or your bank, what would happen is they would have to borrow from the policy and then pay it back, even if they bought a house or whatever they wanted to buy. But because each descendant has a death benefit, that goes back into the trust because the trust owns all the policies. And this is how it went from generation to generation and avoided estate taxes. It's important you understand that. If you want to learn how to become your own bank, go ahead and set up a life insurance policy by clicking the link below. One of the team members here at Epic is going to take you through the success process, not only the full education on exactly what it looks like, but the underwriting process, how to open up a policy, what that looks like from a medical and a financial standpoint. It takes anywhere between 4 and 6 weeks if it's done the right way. And then obviously we're at the mercy of your physicians and getting back the information on your medical. With that being said, though, there's no obligation. The team here is going to do a full cash flow analysis, really be able to show you how to fund and then overfund your policy to become your own bank. I want to thank you for being part of the community, and please don't forget to like, share, and subscribe.